Welcome back to another episode of the Benefits Insider. I'm your host, Chris Hamilton, and today I want to share with you a common question that I get when meeting with employers like you, talking about how to design a higher performance health plan that helps reduce your company's costs, thereby improving your profitability and providing better benefits to your employees while reducing their costs at the same time. And that question is, how disruptive is a program like this? And so I think this is really important to consider. Most of the employers, if you're like the ones that we work with, really want to help their employees. They want to think about their benefits from a standpoint of what can we do for our employees rather than what can we do to our employees. And an important consideration in that is disruption. That could be access to providers, changes in medications. What are the things that we really need to do that don't necessarily negatively impact our benefits, but give us the ability to control our costs. So when we're thinking about disruption, it's really important to understand how a health plan is being used. And what I want to share with you today is what we see across almost all of our clients. If you're looking at an XY graph here, where the Y-axis is the frequency of a claim, and the X-axis is going to be the number of members that are impacted. There's two things that we typically are going to see. When you look at these, it'll make a lot of sense. So if you think about the frequency of claims, right? They're going to go this way, and then it usually tails off to the number of members that are going to be impacted. And these are going to be low dollar. This is going to run in two different directions. We also want to make sure we're looking at cost, also here on the X-axis. A very small handful of your members are going to incur high cost claims. If you look back at your claims report, if you have 100 employees, there's probably 2 to 5 members that drive the majority of the cost of your health insurance. The vast majority of your people are going in to the doctor for a sick visit, a preventative exam, maybe they're taking some basic medication. That's really where, if you're looking at this side of the graph, most of your people are going to fall somewhere in here. These are going to be high frequency utilization, but low impact financial claims. And as you move further to the right, the claims dollars go up per episode and they're more severe cases. So the second thing you want to look at here is what's really driving your utilization as far as dollar spend. That's this graph right here. And so these members are going to be very infrequent but high impact. And as we look at that utilization, it's going to be things like gene therapy. It's going to be things like specialty drugs. It's going to be things like cancer treatments. And then acute cases or acute complications of chronic disease. So this could be somebody with unmanaged case of diabetes that ends up in a diabetic coma in an ICU stay, and they walk out with a $300,000 or $400,000 hospital bill. So when you actually look at this, if you're just a 100 life group, and you can extrapolate this out to your population, but these are the numbers that we typically see. As we put brackets on this, we're talking about a small group, and this really here is your area of opportunity. The vast majority of your employees, if you're looking at this chart, are going to continue to use the plan the way they always have. In fact, the statistics that I typically see is going to be 90 to 95% is business as usual. The plan works the same way that it always has. But this end of the tail, this high cost end of the tail that only accounts for a small handful, a small percentage of your population, this is the area of opportunity where we have the ability inside of the Benefit Insider plan to help these members find the highest quality, lowest cost providers. We can access their medications at a lower cost, really help them get the care that we need. So this is where we talk about doing something for the employees, not something to them. And there are plans out there that have a way to address these sorts of high cost incidences, but we're doing something to the employees, usually limiting their access to the providers they want to see. We're excluding their medications. And those are things that most of the clients that we're working with, this resonates with you. You don't want to do that. You want to make sure your folks have access to what they need when they need it, but you want to make sure we're spending we're paying for it appropriately. And I use the analogy of gas stations or gallons of milk, but let's just talk about gas for a second. If you were to drive into an intersection and on one corner you saw gas advertised for $10 a gallon, you're probably going to look at that and wonder, what in the world? Or $12 a gallon, what in the world? I wouldn't spend that. I can go buy it. I'm in Texas, so gas right now is about $3 a gallon. Gas station on the opposite corner is $3 a gallon. I'm going to go into that gas station to get gas. I'm not going to spend 4 times when I can get it at an appropriate fair price. But that's precisely what we're seeing today in the healthcare market. And when we pay more for claims than we should, when we pay 4 times a fair rate for healthcare, it's impacting our insurance premiums. The more we pay for care, the more we have to pay for insurance to cover those costs. And so the name of the game here is, how can we help this small percentage of our population get the care they need, pay an appropriate price, and our company is able to save, the insurance company is able to save at the same time. This is how you create cost savings. This is how you create sustainability. This is how you enhance the benefits for the rest of your population, because if you think about an average group that's 100 employees, maybe spending $1.2 to $1.5 million a year, a 30% increase to that group is, call it $400,000 to $500,000 of increase in cost. If you're able to lop off that expensive tail, that's now $400,000 or $500,000 that's able to be retained by the employer for other purposes inside of their business. Maybe it's business acquisition, maybe it's investments in capital expenditures, it's bonuses or raises for their employees. There's other more efficient uses inside of your business than giving it away to an insurance company. And the reason why this money ends up getting wasted in healthcare and insurance is it's actually a couple of big reasons, but in summary, if you want more details on this, I've exposed this, I've talked about it at length in prior episodes, but there's a lot of inefficiency built in that exists within healthcare, whether it's prescription drugs that cost exorbitantly different amounts depending on where you're buying your medications. The same thing exists with surgeries and cancer infusions and all of these things that we're talking about. And today, inside of a broad PPO network with no care navigation, employees are left to their own devices and they just randomly end up wherever they go, and we pay, the insurance company pays. We have no control over it, no visibility. And if you can gain that visibility and help your folks find the right providers, giving them the option, we don't force people to go to these providers, but giving them the option to do so empowers them. They save money because when employees engage with these systems, the way we help them is we waive their costs. We waive their cost of care. Think about your average employee that might spend $5,000 or $6,000 out of pocket for care, subject to who knows how many balanced bills by providers. We remove that risk from the employees. We provide the care at no out-of-pocket cost to them, and the employer is able to save because we manage that cost of the care. Everybody wins in that scenario. And so this is really the direction that we see leading employers moving, because they want to be able to manage their healthcare costs the same way they do just about every other expense in their business. So if this is something that you're interested in, I'm going to include a link to the Benefits Insider Playbook. It details the strategy, or it gives you the concept of the strategy that we're using with our employers, that employers are winning today to reduce one of their biggest expenses, adds more profitability to their bottom line, and they're able to put more money back into their employees' paychecks and their pockets. And it's really the direction that we see the market moving, and you're going to see continuous movement over the next 5 to 7 years. The question is, the early adopters are going to have the biggest advantage. As they move into these models, they're able to build up reserves of savings, and it gives them that early mover competitive advantage. I hope this was helpful to you. Use tips like this and others to add more profitability to your bottom line and more money in your employees' paychecks. Take care.